Hello, everyone. Today we will talk about inflation, which has been an area of concern, and how various asset classes or your investments will fare in light of this high inflation. So, if you look at India's economy, we were seeing a cyclical recovery, which is clearly facing some headwinds. We have rising commodity prices, especially oil, which could hurt the incomplete growth recovery. But however, for now, despite the risk, the real GDP may still grow at about 7% in this financial year due to the lower base effects that we have. Consumption demand may face challenges due to high unemployment, moderate wage growth, high inflation, etc. Consumer demand, though improving, is still around that 70 mark. So inflation could be a risk to consumer sentiment again. Export has been an important driver of growth, which will continue to support, but its contribution, which was significantly large over the last 2 years, may marginally see some decline. Also, that geopolitical uncertainty and inflation could moderate global demand, and therefore exports may be slightly lower. Government spending will continue to remain supportive, though there are execution challenges in infra spending, but I think that will remain an important driver of growth. Private investment commitments have been rising, which is an important signal, but actual money deployment is still muted. We will have to see how the private capex picks up. Services growth should be relatively less impacted because of pent-up demand as economies open up. We could see that services growth support the economic growth. Coming to inflation, inflation has been inching higher and will be should be around 6% for this fiscal year. Petrol, diesel, LPG prices will continue to rise, and we will see second round impact will also play out across various goods. Food prices may rise due to high global food prices and also because of increased input cost, such as cost of fertilizers, diesel, seeds, etc., all going up. Given the input cost pressures, the minimum support prices could be hiked by a larger percentage this year as compared to what we have seen was a muted growth over the last few years. It could well be in the range of 7 to 10% this year. Consumer good companies are indicating more pass through in terms of price increases. What's been supportive so far is no impact on wages, rents, and domestically produced food items as yet, but it may follow through if inflation continues to persist. Given all this scenario, the RBI seems to be in a tough spot given that we have high inflation, low growth or growth tapering off, and we have worsening external position. Inflation being the primary mandate will force RBI to hike rates eventually. Supply of bonds is also be high this year, and all in all, from a fixed income allocation perspective, one should avoid duration, at least in the near term, until we see the risk subside or rates move higher, which will make it an attractive entry point. Until that time, I think one should prefer short duration fixed income instruments like liquid funds. Coming to equities, the cyclical growth will continue, although the near-term trajectory may be slower in terms of growth and get pushed back because of inflation, geopolitical disruptions that we're seeing today. Inflation may hit margins in the near term, but some subsiding of commodity prices and eventually good companies will be able to pass on the price increase over a period of time. The pressure on margins should alleviate. What's been the two big drivers of underlying growth in the economy? One is real estate activity picking up, and at the same time, the IT sector doing well, which is leading to higher hiring from these companies. We think that both these drivers should continue to support growth. Low interest rates may inch up, but broadly stay low from a historical context. We have seen that FIIs have been big sellers in Indian equity markets, especially since October of last year till March. But what we have seen in the second half of March is we have seen positive flows coming in. So we may be at the cusp of change, given that the attractiveness of Indian economy relative to other economies is much better. We could see the flows turning positive eventually. And our portfolios are kind of currently geared for cyclical economic recovery, And as we see that economic momentum eventually, as it picks up again, the portfolio companies should start doing well from an earnings perspective. From a gold market perspective, the Fed has lowered growth predictions for the year and raised inflation expectations, thereby amplifying concerns of stagflation. The tightening of monetary policy is fundamentally negative for gold, but there are many macroeconomic tailwinds that are supportive, like high commodity prices, which is leading to high inflation, therefore lower real interest rates, which has been an important driver for gold. Any possible escalation of geopolitical conflict or tensions could also be supportive for gold. On one hand, we have rising inflation and we already have slowing growth, which will also test Fed's resolve to tighten liquidity and hike rates. If you look at bond markets globally, are also flashing recession signals. Possible economic slowdown or any stock market volatility could also be impacting how the Fed behaves. Aggressive tightening in such kind of scenario could also be a policy mistake. Once the uncertainty on geopolitical front eases, tightening of monetary policy by the Fed will be slightly challenging for gold, but various macroeconomic risks will keep gold relevant. There will be some geopolitical premium that will get built in gold prices. So for investors, I think asset allocation is very important. The 12 to 20/80 route, wherein you have 12 months of safe money and rest split between gold and equities at the ratio of 20/80. I think that will help you tide through any type of market scenarios, be it volatility because of geopolitical worries or be it inflation concerns. It will help you prepare for any kind of market scenario and help you achieve your financial goals over long periods of time. So, with that, I'll sign off and wish you all a very happy financial year. Thank you.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.